right. Hi everyone. Let's kick it off. Over the past few years, tokenization has shifted from being a bold concept to a practical reality. Nowhere is this more evident than in money market funds. As institutions take their first steps into this space, what matters most is not just innovation, but the trust, resilience, and clarity that makes adoption possible, as well as real-world use cases and applications. Today, I'm excited to discuss how tokenized money market funds are moving from pilot projects into institutional portfolios and what it will take to build confidence for this next chapter of financial infrastructure. I'm Lior Lamaesh, co-founder and CEO at GK8 by Galaxy. I'm honored to be joined by Kim Hochfeld, Global Head of Cash, Digital, and Securities Lending at State Street. Kim, tell us a bit about yourself and your background.
Thanks, Lior. I think my title sort of reflects this confluence of the digital world and the cash world. So I started my life, as many people in this room, in the money fund space, supposedly a very boring vanilla money asset class. And suddenly, in the last couple of years, I find myself at the center of all the innovation that's going on the blockchain. So my journey reflects our organization's journey in thinking about how DLT can transform both the manufacturing and the distribution of many products and many asset classes, but particularly in the money fund space.
Awesome. A bit about myself. So my background is cybersecurity at the level of national security. GK8 is a Galaxy company. We've been acquired by Galaxy around 3 years ago. Galaxy is a Nasdaq-listed company, market leaders in the digital assets and the AI space. Since 2018, GK8 is in the mission of increasing the level of trust in the market by providing the most secure self-custody solution. We are working with both tradFi and crypto-native companies, enabling them to offer services such as custody, tokenization, staking, DeFi, and more. Amongst our clients are DTCC in the US, BDAX, which is one of the only regulated custodians in Korea. And for this topic today, we have an interesting client as well, which is AllUnity, which is running the fully regulated Euro stablecoin project. AllUnity is a joint venture between Galaxy, DWS of Deutsche Bank, and Flow Traders. And GK8 is partnering to provide the custody and the tokenization technology for this project. It's going pretty well. The TVL is ahead of schedule. It's currently available only for institutions in the first 2 years and supported over multiple chains. So Kim, back to you. Over the last few years, there were many POCs of one-off tokenized assets, such as bonds and more. But now we're seeing institutional products launching and starting to scale. For example, BlackRock's Beedle and Benji by Franklin Templeton. Kim, from your institutional point, why is tokenization, specifically of money market fund, is so compelling these days? What is the advantage of a tokenized money market fund over a traditional money market fund?
Well, I think it's quite simple. Money funds are a fairly well-known and very widely used instrument. I mean, the global money fund, well, the US and European money fund AUM is around $9 trillion in a traditional format. And they become very much part of best practice in cash management in all sorts of contexts. So it's a product that's widely used, widely understood, and very low risk. And as somebody mentioned earlier, 2008, I think the money fund industry has changed enormously since then, and particularly in the US, where the vast majority of money funds are still government-only bills. So really low risk. We've moved past the credit crisis in 2008. And we've survived a number of crises along the way and come out stronger on the other side. So money funds work well. They're very much used and loved by investors, but they're hampered, shall we say, by the mutual fund or the UCITS wrapper in which they are wrapped and then distributed out to the end investor. It's clunky. I don't need to tell anybody that's been working in finance that the mutual fund wrapper is on the way down, and the ETF wrapper, since the advent of ETFs back in the 70s with SPY launched by State Street, that has become the wrapper of choice because it mobilizes an asset. It allows it to move. It allows it to be posted as collateral. So that's a very long way of saying this is what tokenization does for money funds. It creates mobility. And by creating mobility, it obviously all the benefits of the blockchain, 24/7 instant settlement, that's critical for anybody who's moving cash around the world that gets stuck by deadlines and cutoff times. But more important than that, it's the collateral mobility that allows a money fund to be much more widely used as collateral. So we have two killer use cases for tokenized money funds, and I think that's why it's been so exciting to be in this asset class. You know, a tokenized money fund is absolutely an on-chain yield-bearing store of value. We've heard a lot about the rise of stablecoins. You know, let's take the bull case, $3 trillion by the end of 2030. That's a pretty interesting size. But more than that, think about how much collateral moves around the world every day. If you can take some of that cash that's moving as collateral and put it into tokenized money funds, which is with all the benefits that DLT gives that, this is a game changer. So no surprise, tokenization has found its very natural home in the cash industry.
Couldn't agree more.
Lior, can you tell us a bit more where GK8 would come in a tokenization project and how that you could wrap an asset like a money fund?
Sure. So GK8 basically has three main roles in the tokenization from the technology standpoint. First, we are in charge of the issuance process. We have in our product something called the tokenization wizard, which enabling the ability to create smart contract based on a user interface where you can decide what instrument you want to tokenize and what functionalities you want to have in place, and then automatically the smart contract is being created without the need to write any code and deploy to the blockchain. It's leveraging our secure technology for private keys management, which are the impenetrable wallet, which is our technology of how to make blockchain communication without receiving input from the internet. The second piece that we do is the management of the smart contract after it is being deployed. So there is a very sensitive process of managing the admin key in order to do the minting, the burning, to update the allow list capabilities. These are a very sensitive processes that need to be also managed in the most secure way possible. And obviously the third point is tokenizing is custody the tokenized assets. Which eventually is the basic of what we are all about. And I think that since we are not, you know, a regulated entity that need to hold money of no one, but we are working with ones, the way that we needed to design the solution is in a way that helping our clients to comply with these requirements. And you know it very well. So we needed to put in the product things such as the ability to do a segregation of a wallet so the institution can split between the institution assets to its client's assets. We need to do audits on the smart contracts and penetration tests on an annual basis. We need to do AML capabilities, so according to the compliance requirements, assets could be freezed and unfreezed. And also policy engine in order to create a governance, so different users within the bank can do certain functionalities compared to others with certain limits, whitelists, and more. So this is our role in the tokenization side.
Very familiar.
Yeah. All right, Kim. So on your end, what are the main challenges you see when establishing such a project?
I think you articulated a lot of those already. I mean, I sit in a highly regulated US bank-owned asset manager. We're obsessed with things like cyber risk. We're obsessed with AML, KYC, making sure, I can see one of my compliance colleagues nodding in the audience. But it's things that keep us up at night, and we have these governance frameworks and risk frameworks precisely to ensure we're meeting all our regulatory obligations. So, you know, that's a key challenge, and I won't lie and say it's been easy to get around it. It's been a multi-year journey, but as the industry's evolved and the technology's evolved, so has our understanding and our comfort level with what we're building has evolved and increased. Yeah, I'll give an example. I mean, a couple of years ago, we had this very vivid, what's the right word, interesting debate at State Street around the value of going on private versus public blockchain. So, I think so many in financial institutions will recognize this and smile wryly. It's an obvious reaction to prefer a private chain for all of the security that entails. And that's what my banking colleagues on the other side of the house, particularly as a one of the world's largest custody bank, that's a key concern for us. We always, again, obsessed, I'll use that word, about keeping our clients' assets safe. And then I'm sitting on the investment side of the house, the investment management side of the house, and I'm a product manufacturer. So where do I want to push my product? I don't want to keep it on a private blockchain because I've just created a new silo for myself. And where are the pools of capital going? And everything I was learning about the industry was that pools of capital are going to be on public blockchains. So we had to resolve that debate. Again, it's a debate I'm sure many are familiar with, but it's not an insignificant one. Regulation is another key challenge. The world has changed so much since the beginning of this year. I don't think we can underestimate the impact that the Genius Act has had on the entire industry, as you're taking money on chain and all the knock-on effects that brings in a positive sense. So regulation in Europe is obviously a lot more fragmented. We're getting there in some countries. We're a little slower in others, and I'm sure we'll talk a little bit more about this later. And then, another concern for me always, as I'm thinking about new product, is my job is to bring in AUM for State Street Investment Management. I'm not just building proof of concept. So yes, you might have to start with a pilot, you might have to start with a POC, but the end result is, where's the capital moving? How are we thinking about the future? Where will it move? And do we have the right product suite to capture new capital?
Yeah, just 1 point from the security standpoint, it's always a indeed interesting debate, the difference between the private blockchain to the public blockchain. I do believe that it's fine to start with private blockchain, in the POC stages, just to understand how things are going. But it's really hard for me not to tackle it from the security perspective. I do believe that private blockchain is not really achieving the advantages of blockchain by being truly decentralized. As it's sufficient for hackers to control the majority of what equivalent to miners. And when it's a private blockchain, it's not decentralized enough. So it wouldn't be that our job for hackers that would be incentivized. So I'm always for public blockchain. And one of the things that we see challenging, by the way, when we support such projects is the need to support multiple chains. I think when we need to develop the smart contract per instrument, there are certain functionalities that are needed. And we need to develop that. We need to do the penetration tests and the audits of everything. But once we want to move to do it in additional chains that sometimes has different code language for the smart contracts, it's like multiplying the work. And it's something that taking more time that we anticipated, but there is a need to support all of the chains.
And again, as a product manufacturer, I don't want to restrict myself to one chain. So we're aware on the complexity, and then going multi-chain requires additional governance risk and getting comfortable with each different chain. So not an easy lift. So Lior, as a technology provider, what recommendations would you have for anyone launching a tokenization project?
So I think in order to make it successful, there are three main building blocks that should be in place. I think the first one is having a trusted, I would say, traditional finance partner, right? Someone who already done that successfully in the traditional assets world, that already established this trust, because eventually we all understand that it's all about trust, and once you have a well-reputation name, such as you guys, I think it's really something that makes things successful. The second thing is having a strong digital asset partner, right? Someone who's already in the space, who already has a strong connection to all of the needed parties, and truly can bridge the gap between traditional assets to digital assets in order to make it a success. So for example, at Galaxy, we are highly involved in so many projects, in so many things that are going on in the market. We are making liquidity and distribution and market maker and we have a great know-how understanding as to what are the regulatory requirements in order to ensure that the way that the project is built is going to meet everything. And also we have strong connection to different foundations, right? So it means that we bring in investment in advance to these projects, and we kind of ensure that it succeed even before it starts, because there is already enough liquidity since the beginning. And the third point is obviously a trusted technology partner, both for the custody and the tokenization. I think unlike standard custody for cryptocurrencies, when it comes to tokenization, things become more challenging. For example, on the policy engine side that I explained before, when it comes to tokenization, the smart contract requires different kind of control, because you need to have control on the functions on the smart contract level. For example, who can do minting, who cannot, how much mint anyone can do, and really mix and match around that. So having a policy engine on the smart contract level is a new thing to do. So these are the three building blocks that I think any successful project should have in place. Anything on your end?
This is where I rely on your expertise.
Yeah. All right, Kim. So these days, stablecoins and money market funds seem to be the hottest trends in tokenized assets. Why is that, in your opinion? And what do you think is the next trend, and why?
Yeah, I think I talked about this right at the beginning. We have two killer app use cases for tokenized money funds. I think there's a lot. And again, that we were turbocharged by the Genius Act passing at the beginning of the year and being caught up in the whole cash regulatory clarity around stablecoins. Yeah, there's been a lot that's been written and developed here for private credit, private equity. So we look at all the complexity in onboarding new clients, the fact that that asset class is not typically available to retail investors, and we see how tokenization both streamlines the onboarding process, but more importantly, allows for fractional ownership. So, if we look at what has been tokenized to date, the largest category is the private credit market. So, definitely a hot trend, hot on the heels of the cash space, but I believe with a different scale when this whole thing develops. And then we look at what's happened with NASDAQ, with Robinhood, tokenized equity, tokenized ETFs. The whole financial market infrastructure is clearly moving slowly or perhaps quickly on chain. We cannot underestimate the impact of what's happening in that space. And again, yesterday there was a very interesting discussion or comment from Sandy from Franklin Templeton on how there's a shift from an account-based structure to a wallet-based structure. And again, as the fourth largest asset manager in the world, I need to have product that is fit for purpose, that fits into a digital wallet rather than into an account. So the writing is on the wall.
That's interesting. Should we do the last one?
Sure.
Yeah.
Okay. GK8 is first and foremost a self-custody provider. Can you explain a little bit more just on what exactly that means and your role in that?
Yeah. And I know we need to finish so very quickly. Just on the security side of things, which is important for me to emphasize. Eventually, it should be clear that for tokenization, the risk is just like in cryptocurrencies. Eventually, it's all about private keys. Private keys is the one thing that make blockchain centralized. And when it comes to tokenization, the sensitive private key is the admin key, right? The one that can do minting and burning and really control the whole new economy that's being built. And in the project that we are involved currently, we see that in parallel to the on-chain, there is also off-chain source of truth. But it's clear that at some point the source of truth will be on-chain. And we already see some decentralized exchanges and DeFi protocols that are willing to accept stablecoins, for example, as collateral for lending. So it's very sensitive and it's very important to ensure that the admin key is secured and managed in the most secure way possible. And the issue is that today, the way that hackers think is that hacking is about ROI, right? And hackers will invest the needed millions to steal billions. And the approach to look at that is that it should be safe to assume that $1 million is what hackers need to invest in average to compromise in a public internet-connected computer. And the most common solutions today, such as multisig and MPC, are simply not secure enough to manage this admin key, right? Because hackers need to invest like $2 or $3 million to compromise 2 or 3 internet-connected computers to have full control on the multisig and the MPC. And on the other side, there are the so-called cold solutions, which are also not really cold because they're all connected at some point to the internet with a QR code and camera or thumb drive or cables, including the HSMs that are connected. And that's why we brought different security approach to the table, which we call impenetrable wallet, which can make the full process of creating, signing, and sending the messages from the admin key to the blockchain within these superpowers of minting and burning without ever receiving input from the internet. So we truly believe that when we get into production and large scale, this is clearly going to be one of the main painful points that if institutions will not consider and take in place, there would be a very high damage. All right, so just as a closing remark, I wanted to thank you, Kim, for this wonderful discussion. And yeah, thank you, everyone.